right, welcome back to the program. Johnson Chukwu, the Group Managing Director at Cowry Asset Management, is joining me right now. Mr. Chukwu, welcome to you and Happy New Year. Why am I smiling? My team has successfully planned this coup. You know, planning the coup, coming up on air, and we've not spoken in quite a while, I think, you know. So they successfully planned this coup, and I allowed them to do that.
Well, I wouldn't know whether it was a coup. Anyway, Happy New Year, and good to meet you again in the new year.
Happy New Year to you too, and I hope that this year brings better things for us. Now, let's get started because we have quite a lot to talk about, you know. The MPC meeting is underway, I suppose. It will end tomorrow. Straight question, do you see any interest rate hike at this January meeting?
No, I don't think there will be any rate hike at the general meeting. The simple reason I believe the MPC will want to adopt a wait-and-see attitude. A couple of factors are going to impact on the economic performance of the country this year. And it might be preemptive if they want to take a position now, and that position might not be the most appropriate position given that a lot of factors are going to involve. For instance, the U.S. Federal Reserve is likely going to start monetary policy normalization, but they've not started. I am not sure exactly when they're going to start that. Granted, inflation has gone to 7% in the U.S., but until they take that move, if you try to take a preemptive move, you are likely going to increase rates in the country. Of course, the increasing rates in the country will also lead to a slowdown in economic growth rate. And you don't want to step on the brakes on economic recovery at a time when the factor that will compel you to step on the brakes have not really been put in place, have not materialized. So I think the most logical thing they will do is to allow it to remain as severe at the current meetings.
Okay. If you're not seeing any interest rate hike this month, do you see any this year?
Yes, absolutely. We should expect the interest rate to go up this year. I believe several factors will lead to an upsurge in inflation rate. We're already seeing a reversal of the southward move in inflation in December from 15.4% to 15.63%. Those pressures are going to intensify in the current year. I want to believe that it will be compelling for the Monetary Policy Committee to increase rates. I did mention earlier that this U.S. Federal Reserve Bank is likely going to increase rates in the current year. I'd also mentioned that for the first time since June 1982, inflation rate in the U.S. has gone to 7%. And Jeremy Powell had stated clearly that they will not sit back and allow the current inflation to continue to become endemic. So they are going to reverse that. And if they do that, they're going to see a reverse flow of capital from emerging economies to more mature economies, which will put pressure on our foreign exchange reserve and foreign exchange rates. Of course, for the Monetary Policy Committee or the central bank to attract inflow into the economy, they have to allow interest rates to go up. Yield on fixed income instruments will have to go up to become more attractive than yield on fixed income instruments in advanced economies. So that will certainly lead to increase in interest rates. Again, the federal government is adopting a very expansionary fiscal policy with a budget of about 17.1 trillion naira and just about 10 trillion naira in government projected revenue, which clearly will not be realized. You are going to see a lot of liquidity surplus, which the central bank will have to find a way of mopping up. So that liquidity surplus will lead to inflationary pressure. Of course, we know simple definition of economics, layman definition of economics, that when too much money is purchasing few goods. So if that happens, there will be a compelling need to increase it to moderate inflationary pressure. So I think clearly this year we should expect rates, central bank to start normalizing and possibly adopt some level of contractionary monetary policy stance.
Okay, Mr. Chukwu, based on what you have just said now, give me a forecast of how much cuts you expect this year. NPR is at 11.5%, so I need your NPR forecast for this year if the MPC will cut rate by what margin. That is one. And since you're talking about the global economic concerns, let me stick with that a bit. You've raised the United States. We're being told or we're seeing the signs that the Fed may raise interest rates 4 times this year on the back of inflation in the United States is at 7%. How do you think that would really, okay, you said it, really impact us moving forward if we're going to see a rate cut? Then let me bring in the aspect of China, which I've not really seen, you know, analysis on it in terms of this zero COVID policy and how you think it would impact supply chains moving forward. I hope the CBN raises it today, especially as it would impact inflation. Don't forget that we're an import-dependent economy. A lot of our commodities or goods still come in importation and all of that. I hope you understand what I've asked.
Yes, I think I do. Let's start from the China aspects of your question. Of course, we know that China has been dealing with supply bottlenecks since COVID hit home run in 2020. And that has not been fully addressed. If you recall, even in December last year, the British Prime Minister assured British shoppers that they will have the goods that they would need at the shop floors or the shopping malls because they were making efforts to smoothen that supply bottlenecks. So I think that will take some time to be addressed, conclusively addressed. Of course, we know the supply bottlenecks has led to price uptick, to inflationary pressure, because once you are not able to meet supply, prices will adjust accordingly. And that's what we have dealt with. So you have, and part of it is import-induced inflation because of supply bottlenecks created in China. China, as it is today, is the world's warehouse or manufacturing hub. So, but second issue is that the aspect that relates to the U.S. Federal Reserve promising that they will increase rates at least 3 times in the current year. I mentioned that U.S. is witnessing one of the highest inflation rates it has suffered in the past 40 years. June 1982 was the last time the U.S. had inflation rate of as high as 7%. So June this year will be exactly 40 years from then. And that is of great worry to the U.S. and certainly they will increase rates. The impact of rate increase in an economy like the U.S., which is its currency is a primary world currency, will mean that investors will go to dollar will strengthen, and the dollar strengthens, investors will move their investments away from emerging economies and move to U.S. And what that will mean is that reserves in emerging economy will come under pressure. Even Chinese President Deng Xiaoping did mention that in the WTO address and was kind of cautioning the U.S. against rate increase because of the negative impact it's going to have on emerging economies. Nigeria's case also actually worsened by other factors, endogenous factors, one of which, apart from the pressure that would come to bear on our reserve as a result of reverse flow of portfolio investors back to matured economies, is the fact that even as we are seeing commodity prices recover, we are not getting the impact of the commodity price recovery. We're actually getting the pains of commodity price recovery. Simply that we cannot produce enough crude. If you recall, our December OPEC quota, I think December or November OPEC quota was 1.98 million barrels per day. November OPEC quota. We only produced about 1.39 in that month, which meant that we had a shortfall of close to 400,000 barrels a day. Even with the current, our general OPEC quota was 1.701 million barrels. We are not likely going to meet that. What that means is that we are still not able to export as much as we could have exported to foreign exchange. At the same time, we are spending the foreign exchange we have to import refined petroleum products. Market prices, Platts touched more than almost $90 last week per liter, what do you call it? For AGO, that is automated gas oil. Not a barrel.
A liter.
If you look at, for instance, each barrel, not liter, of gas oil was about $89 per.
Okay.
And then for us in Nigeria, we have to buy that and also import refined PMS. And unfortunately, we are not exporting at the quantity we should be exporting to be earning enough foreign reserve or foreign income to import those quantities. So what you have is that you are earning less, despite the fact that prices have increased, but you are not earning enough of revenue from your crude oil export because you're not producing enough. At the same time, you are buying refined petroleum products at market rates. So you realize that your reserve is suffering a diminution or reduction in volume because you are now paying more. Your balance of trade has turned negative. You are paying more for your imports than you are earning from your exports. And that's what some of the challenges we have today. So the three major sources of revenue from foreign exchange revenue for Nigeria, or foreign exchange inflow, which is sale of crude oil. We are not doing enough. We are not producing enough crude to sell. Two, from portfolio investors that will reverse further. We're already having a slowdown in portfolio investment in the country because of shortage of FX to meet the demands of those who have sold their portfolios. So that will further reduce as US adopts normalization of monetary policies. And then diaspora remittances. In a pre-election year where there will be heightened political tension, the Nigerian diasporas will reduce their remittances locally because they want to stay and watch how the political environment plays out. So you realize that ultimately, we are not going to have enough foreign exchange inflow this year, which will put pressure on exchange rates as it is exact pressure on reserve. So, and then while your imports will at the minimum remain where it was, because you still have to consume the same quantity of petroleum products, unless the government has a bold to take the bold step to remove the subsidy.
You've raised a lot of concerns, and I hope that we'll have time to take a look at all this. But I want to ask you this very fundamental question, which is, what is the origin of our inflation, really? What is the origin of our inflation? I know the data, food, and all of that. But with what you've said now, what is the origin of our inflation? And with what we've seen, December inflation rising to 15.63% in December, do you think that inflation is driven, at least the one we saw in December, was it driven by supply limitation, or was it really driven by demand, an upside in demand? Mr. Chukwu, I hope you're understanding what I'm trying to say.
Yes, I do.
I'm trying to.
When you talk about the origin of current inflationary pressure, it started when the federal government banned importation of food items through the land borders, which constrained supply, well as there was no commensurate increase in production, local production. So we saw an uptick in inflation rates, which plateaued in March 2021 at 18.17%. But eventually the government had lifted that a ban on importation of when they closed the land borders. But subsequently, we've seen a heightening in the level of insecurity across all the food belts. And we know that food inflation, the food component, is a critical component of all item inflation. So if you see a restriction in food production, which has led to food supply shortages or shortages. So you will see that current pressure on inflation is coming from two angles. One is supply bottlenecks as a result of slowdown or reduction in food production occasioned by insecurity. That's the core of the problem we're having today. Added to that is the fact that because our foreign reserves have come under pressure, we've seen a depreciation in local currency. So you find out that even the goods that are imported into the country, their prices the landing costs have actually increased as a result of depreciation of the local currency. So you have shortage of food production, which has led to an uptick in food inflation, and bottlenecks in accessing FX or depreciation of the local currency, which has increased the cost of imported food goods into the country. So those two major factors are the major propellers of inflation in the country.
Okay, let's take a look at this now. How much of these high prices are producers passing on to customers and consumers? For example, you lead an asset management firm. How much of these prices, have you also shifted to your customers? I don't know if we have that data, producer price inflation in Nigeria. I don't think we calculate that. I've not seen that. But I think in other countries they do calculate that, PPI in Ghana and South Africa and the rest of them. So how much of these high prices have we seen extended to consumers of both goods and services?
Okay, what I would say is that the ability of a business person to pass on costs, increase in cost to consumer, depend on the elasticity of demand of their product. So if it is elastic, if the demand is elastic, you realize that the producer or the middleman absorbs most of the cost differential, or most of the cost increment. But if the demand is inelastic, then the consumers will bear the burden of that price increases. So it's in terms of the incidence of price increase across between the producer or the marketer and the consumer, it depends on the elasticity of the product. So you have different capacity to pass on costs. Some products, as it stands today, take for instance things that are inevitable or necessities, you find out that the consumers have to bear the burden of those price increases. And that's why food is the one that is carrying most of the burden of transmission of cost increase in cost. So because you really can't afford to not to eat the food. But again, another component that suffers from this increase is that consumption will actually decline. So you find out that if you go to the businesses who are into consumer goods, consumer good businesses, they will tell you that demand for their product have reduced drastically. And that's one of the reasons why the recovery of the economy has been quite slow, because consumer demand declined as a result of the average consumer losing purchasing power or disposable income as a result of inflation and exchange rate depreciation. So each commodity class will have the ability to pass on the any increase in cost to a final consumer determined by the elasticity of that product, demand for that product. In our own area of business, we are currently contending with increases in SEC fees. So, but that will be difficult for us to pass on easily because your consumers are only investing their disposable income or their net, their savings. They only invest their savings, and they are looking at return on their investments. So, if additional cost burdens would make them reduce the return on their investment, and they have returns, they look at the opportunity cost of those investments, they make move the investment to some other products or some other classes. So for us to pass on cost burden will be difficult, but some businesses find it easy to pass on the cost burden to the final consumer. But ultimately, what happens is that the economy suffers when costs are escalating because consumption will decline. When consumption declines, production will decline and employment will also decline.
When you were talking about this, what actually came to my mind is that Nigeria has emerged a saturated economy, and it's really worsened under this administration, at least from 2015 till now. If you want to take a look at what people are buying, if they can't buy the full tin of 300 gram, for example, of milk, you see the sachets, everywhere of 50 naira. You know what I'm talking about. Because of high inflation, people cannot afford that again. But that's a topic for another day, which I will get into. I want to ask you this question, which is and it's a very tricky one, and I want you to really listen well so that you know how you will answer me. It goes like this.
You can see the way I sat up. This is a tricky one.
Would you say that Nigeria is really out of a stagflationary environment? Or are we really out of a stagflationary environment, or are we still in it? Let me explain. Stagflation, definitely high unemployment, high inflation, GDP growth rate that is slow. But if you take a look at our inflation rate, it's high, unemployment rate is high, GDP growth rate, we posted a positive one, about 4.03% or so in the last quarter of 2021. But if you take a look at it, we're still in the minus, so to speak, population rate about 2.6%. So are we really in a stagflationary environment, or are we out of it? Or we never even left? This should be a question for economic students.
Of course, we are dealing with an inflation rate of currently dealing with inflation rate of 15.63%. The last GDP figure was 4.03%. I mean, the fourth quarter GDP figure. That was a decline from about 5.01% we saw in the second quarter of this year. In terms of economic growth, that will show you that the GDP grew by about 4.03%, 4.01% in the third quarter. But inflation currently is about 15.63%. And then if you look at unemployment, the last unemployment figure say that we have an unemployment figure about 33.3%. So you are seeing a situation where the economy is not growing as fast as the rate of inflation. And unfortunately for us, that growth in economy is not likely to accelerate much further. If you look at the projections by major international organizations, international financial institutions, the IMF is projecting the economy to grow about 2.7%. World Bank actually thinks it will grow at about 2.5%. Economic Intelligence Unit believes the Nigerian economy will grow about 3.3%. But the federal government is projecting that the economy will grow at 4.2%, which we all know is quite optimistic. Of course, the government should be the one who is selling optimism in the economy. So that's understandable that they are projecting the economy will grow at 4.2%. But as long as the economy is not growing at the rate at which population is growing, then you have a high unemployment rate, high inflation rate. You are dealing with stagflation because ideally, if in economic management, you can stimulate inflation so that you can to improve economic growth rate. If inflation is high at the current level it is, and the economy is not growing at a very supersonic rate, then you are dealing with a difficult situation. I refer you again to the broadcast made by the Chinese president. He said that the Chinese economy was able to achieve the twin objective of low inflation and high growth rate last year. He said the economy grew at 8%, while they have maintained a very low inflation rate. That is the target of any good economic manager. But unfortunately for us, we are dealing with the converse, where inflation is at 15.63%, the economy is struggling to grow at above 2%. So we're clearly dealing with stagflation. Unless we have drastic restructuring and address those factors that are driving inflation. And like I said, those factors are structural. They are not monetary issues. We are talking of production, food production bottlenecks, local food production bottlenecks. You are not dealing with that. You are dealing with crude production that has actually reduced to one of the lowest level and actually affecting our foreign earnings and making it difficult for the central bank to have the tools to manage exchange rate. So those factors are still there with us, and they don't seem to be going away in the immediate future.
Mr. Chukwu, in just about 45 seconds, because we've got to go, what is your outlook for inflation this January from 15.63% to what? Then how do you think that Nigerians should hedge against inflation? 45 seconds.
Okay, I think we should see a slightly further increase in inflation, maybe not at the magnitude we saw in December, because we are moving towards the planting season, and then food scarcity worsens during the planting season. So I think.
Oh. Okay. The network has failed there. Mr. Chukwu, I'm afraid the network just cut you off. So sorry about that. All right, that's the much you can take on today's edition of the program. We hope to see what the MPC will decide on Tuesday here in Abuja, the CBN headquarters, perhaps 2 p.m. Nigerian time. Trust us to keep you up to speed with it. Mr. Chukwu, I can see you. I'll just have to say bye-bye to you because we can't come back to you now because of the network. And let's talk again sometime soon. That's the much you can take. I am Nancy Naji. Be the best you can be and be the change that you want to see. Don't forget to join us on our YouTube channel. You can subscribe right now, Moneyline with Nancy TV, and get available knowledge materials there. I'll see you all tomorrow. Bye now.